These stocks could make you $100,000. In this video, I'm going to discuss a few companies and how they can make a return of $100,000. The last stock has 10x potential. The first stock on the list is PayPal Financial. They specialize in electronic transfer of funds via their app PayPal or their newer platform Venmo. PayPal closed at $67 per share today at a $71 billion market cap. They are under new management by Alex Chris, who was previously on the management team of Intuit, so this guy has prior experience building a behemoth. PayPal alone from a valuation standpoint is a deal. If you go back and listen to the last earnings call, you can clearly hear management say they are being conservative with their forward growth estimates. While expected to grow revenue over 10% this year and 8% next year, they are expected to grow earnings per share by over 10% next year, which means they have more profit hitting their bottom line for every dollar of revenue made. PayPal trades at a very cheap valuation at just under a 13 price-to-earnings ratio, while the average stock trades at a 23, with a trailing 12-month earnings per share of $5.11. When you take management's projected growth rate and combine that with their $5 billion share buyback program, you get an earnings per share of roughly $6.75 in just 5 years. That alone gives the stock a 31% return from its current price of $67 to $88, assuming it stays at the current 13 price-to-earnings ratio. When Alex Chris proves he can turn the company around, the stock will demand a higher premium of perhaps a market average of 23 price-to-earnings that puts the stock at $148 a share, a very nice 120% return on investment. But the real money will be made when PayPal demands a premium price to earnings like its peers at 42, giving the stock an astounding 322% return. Meaning one would only have to invest $23,800 to make $100,000. Next up on the list, we have Shake Shack, ticker symbol SHAK. Shake Shack is a fast-growing restaurant stock that has dominating in popularity and cultural delights. While the company trades at a premium price-to-earnings ratio of 216 at today's price of $98 per share, it's well-deserved, and at the company's current growth rate, they could eat that high valuation up very quickly. The company's current valuation is just over $4 billion. To value this stock, we will be using a different metric to better value a franchise company known as price-to-sales ratio. When you take the company's current market cap of $4 billion and divide it by the projected revenue of $1.15 billion, you get a price-to-sales ratio of 3.5. I've found Chipotle to be the most similar company compared to Shake Shack, which trades at a 6 price-to-sales ratio, so we will be using that as our starting point. Analysts predict Shake Shack revenue will grow at a 5-year average growth rate of over 20%, which is insane for a food company, meaning it would take the company roughly 4 years to reach $2.4 billion in revenue a year. With over 500 Shacks currently out there ringing cash registers and over 40 more on the way per year for the foreseeable future, the stock should be able to demand these types of prices, putting it at a $9.6 billion market cap at just a 4 price-to-sales ratio, a $14.4 billion market cap at a 6, and a whopping $19 billion market cap at a 8 price-to-sales ratio, giving Joe a solid return of 350% return on investment, meaning he would have to invest just $22,300 to total $100,000. Significantly less than the first option. This last company has a possibility to make life-changing returns. Fubo TV. You've probably seen this one pop up on the home screen of your Roku TV. This company trades at a market cap of just under $500 million, with over 1.6 million paid subscribers and growing that number over 12% per year, and an annual revenue per user of over $86. This company is not yet profitable, but they are getting closer every year. They have proven they have significant pricing power over their content, as the prices have more than doubled since 2017. Companies in this industry typically have a 10% profit margin, so we can use that for our projections. We're going to 5 years out for this one to give the law of compounding time to take effect. Remembering the companies is currently doing $400 million in revenue per year, and analysts have this company growing revenue at over 20% per year. That gives us a total revenue by 2030 of $1.2 billion per year. Assuming a 10% profit margin that tells us that $120 million is hitting the bottom line net income. Now divide that number by the outstanding shares of 293 million, that gives us an earnings per share of 40 cents. It is absolutely nothing for companies in this industry to trade at 40 price to earnings ratio, which conservatively puts this stock at $16 per share, which is more than a 1,000% return from its current price point of $1.55 per share. Making this Joe's number one pick to turn just $10,000 into $100,000. Please drop a comment and let me know what stocks you want to see projections for next.